After a hot and dry summer, temperatures are cooling. But investors may still face a hot autumn amid worries about trade, emerging markets, Italy and Brexit. So is this the time to head for safe havens now, waiting for the next shoe to drop? Investment returns in Europe have been generally mediocre this year. But US equities keep defying global risks, hovering close to record highs. By contrast, emerging markets sold off in summer. Weak spots like Turkey and Argentina remain fragile. Emerging markets in aggregate, however, are largely held hostage by indiscriminate selling. Fundamentals are generally better than in 2013, let alone during the late 1990s Asian crisis. Recent emerging markets pressures neither about the Fed. Unlike during the 2013 taper tantrum, emerging market currencies have moved in tandem with US rates. Instead, trade war worries are casting a long shadow over markets, as this chart of market-based trade concerns is showing. Trade tensions will continue to linger. Nerves have calmed a bit recently, but the 10% US tariff on another 200 billion imports from China imposed recently will rise to 25% if no deal is struck by year-end. The campaign for US midterm elections will leave little room for compromise anytime soon. Meanwhile, in Europe, the relief on Italian debt in mid-September proved short-lived. The government announced to target a 2019 budget deficit of 2.4% of GDP, a sharp deterioration from previous commitments. Markets are alarmed. A prolonged dispute with the EU may be looming. BTPs may be a more persistent source of market unease. However, hiding in low-yielding safe assets is unlikely to pay off. The global economy is still resilient enough to withstand the headwinds from trade. The Fed will continue to tighten while inflation continues to recover. Real bond yields are still depressed at -1%, despite decent activity and rising wages. We still see the way paved for higher global core yields, even if market uncertainties will contain the rise. At current global growth dynamics, equities still have a decent potential to outperform fixed income assets. We trimmed our overweight in cash, but remain cautious on duration. We have guardedly increased our exposure to equities after the September setback. We are tactically neutral on corporate bonds, but prefer lower-rated, short-dated titles over higher quality with longer durations. Investment opportunities are building in emerging market hard currency bonds. Cool nerves are warranted for a potentially hot autumn. Good investments? We will keep you posted.